If you think you need thousands of dollars to start investing in stocks, you're wrong. If you think stock investing is gambling, you're wrong. And if you think you need to pick individual stocks to make money, you're dead wrong. Here's the truth that Wall Street doesn't want you to know. You can start investing with just $1, and there's a proven strategy that beats 90% of professional fund managers. Hey everyone, I'm Alex Sterling from Money Street 101, and in the next few minutes, I'm going to destroy every excuse you have for not investing and show you the exact blueprint that turns regular people into millionaires. We're talking real strategies backed by 2025 data, not outdated advice from your dad's investment book. Here's what we're covering: why your brain is sabotaging your wealth, the one investment that beats almost everything else, and how to start investing today with whatever money you have right now. Plus, I'll show you the biggest mistakes that destroy beginner portfolios and how to avoid every single one. This is your complete roadmap to building wealth through the stock market. Let's get started. Before we talk about what to buy, we need to fix your brain. Because here's what 2025 research revealed. 64% of investors think they're experts, but only 25% of professional fund managers beat the market. Your biggest enemy isn't market crashes or bad stocks, it's your own psychology. Let me show you the investor emotion cycle that destroys wealth. You start with optimism when markets are rising. That turns to excitement, then euphoria. You're buying everything, feeling like a genius. Then the market drops. Optimism becomes anxiety, then denial, then panic. You sell everything at the bottom. Sound familiar? Here's the brutal truth. Losing $100 feels twice as painful as gaining $100. Feels good. This is called loss aversion, and it's why people keep money in savings accounts earning 0.1% while inflation steals 3% annually. You're literally paying to be safe. The solution? Automate everything. Remove emotions from the equation. The most successful investors in 2025 aren't the smartest. They're the most systematic. They invest the same amount every month, regardless of what the market is doing. No emotions, no timing, just consistency. Ready for the secret that beats 90% of Wall Street? It's not a hot stock tip. It's not crypto. It's not some complex strategy. It's an S&P 500 index fund. That's it. Warren Buffett has been saying this for decades, and 2025 data proves him right again. Here's why this works. When you buy an S&P 500 ETF, you own tiny pieces of the 500 largest companies in America. Apple, Microsoft, Amazon, Google, you own them all. When these companies grow, you grow. When they pay dividends, you get paid. The numbers are incredible. Over the past 15 years, the S&P 500 returned about 10% annually. That means $100 monthly invested for 30 years becomes over $200,000. But here's the crazy part. Over 90% of actively managed funds can't beat this simple index. Professional managers with Harvard MBAs, billion-dollar research teams, and supercomputers get beaten by a simple fund that just buys everything. Why? Because they're trying to be smart. They're picking stocks, timing markets, and charging fees. The index fund just sits there and grows with the economy. My recommendation? Start with SCHD or IVV. SCHD focuses on dividend-paying stocks with expense ratios of 0.06%. IVV tracks the S&P 500 with expenses of just 0.03%. Both are available commission-free at major brokers. Now let's talk about where to actually invest. 2025 changed everything about investing platforms. Commission-free trading is standard. You can buy fractional shares with $1. Most platforms offer paper trading so you can practice without risk. Here are my top picks. Fidelity wins for education and retirement accounts. Their research tools are incredible and perfect for beginners. Schwab is best for bond investing and has the most established reputation. Webull offers the most advanced tools and unlimited paper trading. SoFi has the simplest interface if you want something super easy. But here's what nobody tells you. The platform matters less than your behavior. Don't chase the newest app or the flashiest interface. Pick one and stick with it. Platform hopping disrupts systematic investing. Most beginners make this mistake. They spend weeks researching the perfect broker instead of just starting. Analysis paralysis kills wealth. Any of the major platforms, Fidelity, Schwab, Webull, even Robinhood, will work fine. What matters is that you start investing consistently. One critical feature to look for: automatic investing. You want to set up recurring purchases of your chosen ETF. Most platforms let you invest as little as $25 weekly or $100 monthly on autopilot. This removes the temptation to time the market or skip months. Here's the part most YouTubers skip. Taxes will destroy your returns if you're not careful. 2025 tax brackets for capital gains are brutal if you don't understand them. If you hold stocks for less than 1 year, you pay ordinary income tax rates up to 37%. But hold for over 1 year, and you pay capital gains rates 0% if you make under $48,350, 15% up to $533,400, and 20% above that. The difference is massive. But here's the real secret. Use tax-advantaged accounts first. Roth IRA contributions grow completely tax-free forever. You can contribute up to $7,000 annually if you're under 50. Traditional 401k contributions reduce your current taxes. The strategy is simple. Max out your Roth IRA with index fund investments first. If you still have money to invest, use a taxable account, but focus on tax-efficient funds. ETFs are more tax-efficient than mutual funds because of how they're structured. And never, ever day trade in a taxable account. Every trade creates a taxable event. Day traders can owe thousands in taxes even if they lose money overall. This is why buy and hold investing isn't just better for returns, it's better for taxes. One more tax hack. If you have losses in your taxable account, you can harvest them to offset gains. It's called tax loss harvesting, and it can save you hundreds annually. Let's build your actual portfolio. Now, I want to show you something interesting first. 2025 data from high net worth investors. We're talking people with millions in assets. Shows their allocation model. 7% public stocks, 15% private companies, 17% real estate, 8% alternatives, and 13% in bonds and cash. But as a beginner, this is not your starting point. Here's your starter portfolio. 80% total stock market index fund if you're under 40. 70% if you're over 40. The rest in bond funds or high yield savings. That's it. No complex strategies, no sector betting, no individual stock picking, until you have at least $50,000 invested. Why start simple? Because complexity kills returns. Every additional investment decision is another chance to make a mistake. The data is clear. Simple portfolios outperform complex ones for beginners. As you learn and grow your portfolio, you can add complexity. Maybe 5 to 10% in individual stocks you understand. Maybe some international exposure through total world funds. But start with boring basics. Age-based allocation works. Subtract your age from 100. That's your stock percentage. 25 years old, 75% stocks. 45 years old, 55% stocks. This automatically reduces risk as you get older and can't recover from major losses. Rebalance annually. If stocks outperform bonds, sell some stocks and buy more bonds to maintain your target allocation. This forces you to buy low and sell high automatically. Should you invest everything at once or spread it out over time? 2025 research settled this debate. Lump sum investing beats dollar cost averaging 68% of the time over 6 months and 92% of the time over 36 months. Mathematically, investing everything immediately wins. But here's the psychological reality. Most people can't handle watching their entire investment drop 20% the week after they invest. Dollar cost averaging feels safer, even though it's statistically inferior. My recommendation? Compromise with a 3-installment approach. Invest 1/3 immediately, 1/3 in 30 days, 1/3 in 60 days. This balances mathematical optimization with psychological comfort. For monthly investing, just automate it. Set up automatic investments of whatever you can afford. $50, $100, $500 monthly. The key is consistency, not timing. Don't try to wait for the perfect moment. The best time to invest was yesterday. The second best time is today. Market timing is a myth. Even professional fund managers with teams of analysts can't time markets consistently. Your job isn't to be smart, it's to be systematic. Boring beats brilliant in investing. The beauty of dollar cost averaging is it works with human psychology. When markets are high, your monthly investment buys fewer shares. When markets are low, your monthly investment buys more shares. Over time, this smooths out volatility and reduces your average cost. Let me save you thousands of dollars by showing you the mistakes that destroy beginner portfolios. Mistake number 1. Chasing hot stocks. You see Tesla up 50% and think you've missed out. So you buy at the peak. Then it crashes 30%. Panic selling follows. Buy high, sell low, the perfect wealth destruction strategy. Mistake number 2. Overthinking your first investment. You spend months researching the perfect ETF instead of just starting with a total stock market fund. Analysis paralysis costs more than imperfect action. Mistake number 3. Checking your account daily. Markets fluctuate. Your portfolio will be down some days, up others. Daily checking triggers emotional reactions. Check monthly at most. Mistake number 4. Believing you can time the market. Waiting for the right time to invest. There is no right time. The market hits all-time highs regularly. That's how growth works. Yesterday's high becomes tomorrow's normal. Mistake number 5. Stopping your investments during market drops. This is exactly backward. Market drops are sales. You should be buying more, not less. The best returns come from investing during market fear. The solution to all these mistakes? Automation and education. Automate your investments so emotions can't derail you. Educate yourself about market history, so you understand that volatility is normal, not dangerous. Here's your step-by-step action plan to start investing in the next 30 days. Week 1. Open a brokerage account. Choose Fidelity, Schwab, or Webull. Don't overthink this choice. Open a Roth IRA if you have earned income, or a taxable account if you don't. This takes 15 minutes online. Week 2. Set up automatic investing. Choose a total stock market ETF or S&P 500 fund. SCHD, IVV, or VTI are all excellent choices. Set up recurring investments of whatever you can afford. Start with $50 monthly if that's all you have. Week 3. Practice with paper trading. Most platforms offer virtual investing with fake money. Use this to get comfortable with the interface and understand how orders work. Make mistakes with fake money, not real money. Week 4. Make your first real investment. Start small. Buy your first shares of your chosen ETF. Celebrate this moment. You're now an investor. Then forget about it. Don't check daily. Don't try to time additional purchases. Let your automatic investing system work. Focus on increasing your income and investment amount over time. The goal isn't to get rich quick. The goal is to get rich slowly and surely. Compound growth over decades turns small amounts into life-changing wealth. But it only works if you start and stay consistent. You now know more about investing than most people learn in their entire lives. You understand the psychology, the platforms, the tax implications, and the proven strategies. The only thing left is action. What's your biggest obstacle to starting? Is it fear of losing money? Not knowing which platform to choose? Not having enough money to start? Drop your specific concern in the comments. I read every single one and often turn your questions into full videos. If this video gave you the confidence to finally start investing, smash that like button and subscribe to Money Street 101. We're building a community of people who are serious about building wealth through proven strategies, not get-rich-quick schemes. Your next step? Watch my video on the psychology of money to understand the mental game of wealth building. Understanding both the tactical and psychological aspects of money is what separates successful investors from everyone else. Remember, you don't need to be perfect to start investing. You just need to start. The best investors aren't the smartest, they're the most consistent. Your future self will thank you for starting today. I'll see you in the next video.